Hello, welcome to the Credit Compass, your guide to navigating the complexities of European credit markets. Each week we unpack the key developments shaping credit, explore the macroeconomic forces at play, and dive into the strategies that matter most for investors across Europe and the UK. This week we will look at why the low cost of oil and the futures curve, known as contango, may be quietly sending signals that matter for corporate credit, and how recent European earnings, including both some positive signals from listed corporates to slightly more cautionary tales from the hospitality sector. All right, let's take a look. Now, oil prices remain subdued, offering many European issuers welcome relief, lower input costs, less inflation pressure, and an easier operating environment. But beneath the surface lies something less benign. The futures market is signaling contango, meaning longer-dated oil contracts are priced above the current spot. That suggests storage costs, oversupply, or weak near-term demand. The cost of carry, storage, insurance, and financing is built into the futures price. In practice, you could buy oil today, store it, and deliver it later. If the futures price is sufficiently higher than spot, you can profit after those carrying costs. And right now, roughly 1 billion barrels of oil are sitting in tankers being held for future sale, the largest amount in transit since 2020. For European corporates that rely on energy inputs, cheap oil is a tailwind. But the curve tells us not to assume demand is strong. Oversupply or weak consumption may be lurking beneath. If demand softens, top lines suffer and margin relief from energy fades. At the same time, lower inflation from cheaper energy gives central banks a bit more room to ease. But if contango reflects faltering demand, it could be an early warning of a broader economic slowdown. From an inflation input perspective, as my colleagues noted earlier this month in a note, oil now plays a smaller role in Europe's cost structure. The region is less exposed to energy shocks, yet oil still matters. It remains the largest single energy source, even as renewables grow. Falling oil prices likely haven't moved the needle much for Q3 results, but earnings are starting to come in. European listed companies are navigating a mixed environment. Input cost relief helps margins, but currency headwinds, wage and lease inflation, and soft demand weigh on performance. Consensus earnings per share growth for Q3 sits at around 2.6%, modest at best. For credit investors, the story isn't headline profit, but cash flow, of course, interest cover, debt service, and refinancing capacity. Now, let's look at a few examples that we have seen that have been early reporters. Let's start in France. Forvia, the auto parts group, reaffirmed its full-year outlook even as it warned of fourth quarter production headwinds. Management called out chip bottlenecks and freight disruptions, but stuck to its cash flow and cost-cut targets. Over in Sweden, Volvo told us Europe remains steady even as North America looks weaker through 2026. Service revenue keeps growing, smoothing the truck cycle. In the UK, demand for post-pandemic travel remains resilient. One major operator, TUI, reported pre-tax earnings up more than a third in the third quarter, upgraded full-year EBIT growth to 9 to 11%, and flagged strong early bookings for winter 2025-2026. ABB's latest update had a clear through line. Data center and AI demand are powering its electrification and automation divisions. They're guiding mid-single-digit revenue growth in the fourth quarter and margins at the high end of their target range. Europe's tech heavyweight ASML guided fourth quarter sales between 9.2 and 9.8 billion, implying roughly 15% full-year growth, and said 2026 sales will be no lower than 2025. Yes, China demand will fall, but management expects AI logic orders to more than fill the gap. While many think of data center builders, chip makers, and big tech as the main beneficiaries of the AI boom, advertising giant Publicis raised its full-year growth guidance for the second time, now targeting 5 to 5.5% organic growth, all thanks to surging AI-driven digital marketing demand. From Switzerland, Nestlé reiterated its 2025 targets, organic growth led by real volume gains, or RIG-led growth in their language, and a margin floor of at least 16%. A cost-cutting program runs through 2027 to help support margins. LVMH returned to growth in Q3, highlighting stabilizing demand in Asia and resilient selective retailing. Management was cautious into tough holiday comparables, but clearly more confident than last quarter. Now, enter Whitbread plc. This is a UK-based hospitality group, the owner of Premier Inn, operating in both the UK and Germany. In its latest half-year, adjusted pre-tax profit fell 7% year-on-year. The company emphasized that forward visibility remains limited for the UK business, which we suspect will be an ongoing theme amongst UK-listed companies as they await the results of the upcoming budget in November. UK companies have only just recently managed to adjust for the impact of the last budget on their bottom lines. For the German segment of Whitbread's business, the outlook for profit has been trimmed. Demand softness in Germany and cost pressures, inflation, leases, labor were all cited. Overall, it is a mixed set of results, with a fair bit of wait and see. This matches with what we are seeing in both Germany and the UK from a macro perspective, as both regions look to 2026 to hopefully see the start of a turnaround. In Germany, we had some interesting comments from the German Chancellor Friedrich Merz. In his own parliament, he urged the EU to accelerate its integration of the capital markets and reduce bureaucratic hurdles. He iterated that he would like to see a Wall Street for Europe, a unifying European stock exchange so that successful European companies don't need to go to the New York Stock Exchange to gain funding. Currently, there are 15 securities exchanges in the Eurozone, all providing regional support for companies. To raise large amounts of capital, European companies tend to approach the US capital markets for a deeper pool of funds. A single exchange would help to increase the attractiveness of listing locally for European companies. Appropriately, ThyssenKrupp, spin-off TKMS, a ship and submarine builder, just recently tapped the markets in Frankfurt with a successful IPO. Let's hope there are more to follow. So, what do we take away from all of the results so far? Well, cyclicals are leaning on cost and service income to defend their cash flows. Secular growth names, ABB, Publicis, ASML, are guiding higher on AI and electrification demand. Defensives like Nestlé are rebuilding real growth, and even luxury and media are signaling stability rather than contraction. For a European credit investor, that translates into spread differentiation, not deterioration. As our latest forward look highlighted, published last week, go check it out, it is more about credit quality. High yield has begun to price wider, signaling a slight flight to quality. Not dramatically, but warranted in this slightly more volatile period we have been going through in the last few weeks. Guidance resilience tells us margin risk is easing, even if some macro headwinds do still persist. Low oil cost is broadly supportive, but don't mistake that for a free pass. The shape of the futures curve suggests oversupply and/or weak demand, which signals risks and acts as a potential early signal for future challenges. European companies are offering modest earnings growth and cautious guidance, with the occasional exception. As a result, name selection and sector differentiation matters. Demand-sensitive sectors like hospitality, leisure, and certain industrials are still under pressure even if input costs are benign. Examples like Whitbread show this. That's it for this edition of the Credit Compass. If you found today's episode valuable, follow, rate, and share the podcast. And if there's a topic you'd like us to explore, drop us a line. We'd love to hear from you. For deeper credit insights and ratings, visit KBRA.com, where you can find the latest publication of our European Forward Look, as well as the one for the US from my colleague Van Hesser. Until next time, stay curious, stay informed, and stay resilient. Let the Credit Compass help guide your way.